My guest today is Professor Viral Acharya, who is Professor of Economics in the Department of Finance at New York University Stern School of Business. He was a resident scholar at the Federal Reserve Bank of New York and a deputy governor at the Reserve Bank of India, RBI, from 2017 to 2019, in charge of monetary policy, financial markets, financial stability, and research. Welcome, Viral.
Thank you so much, Gill. Pleasure to be here.
Yeah, thanks for doing this. So I got a number of your papers, and I want to start with one of your. And I think you did this with Raghuram Rajan of Chicago. Sovereign debt and economic growth when government is myopic and self-interested. You say here we examine how a sovereign's ability to borrow abroad affects the country's growth and steady state consumption when the government is both myopic and self-interested. Surprisingly, you say government myopia can increase a country's access to external borrowing and extend the government's effective horizon, giving it a stake of incentivizing private production and savings despite its self-interest. So it's a bit counterintuitive. I want to. I haven't seen too many governments or politicians who are not myopic or self-interested. Um, and so this seems like a common theme, whether you're a developed country or yet to be developed. But I take it back. So actually, my grandfather, my wife's grandfather were colleagues at the first assembly in Kerala after independence, and those guys were actually pretty good. The first generation of Indian politicians were or self-interested. But now we have a situation that that's not quite true. So let's get into the sort of the technical aspects of this. So you're saying this could potentially be good for some state of development, right?
Yeah, so I think you hit the right spot, which is that our view is the same, which is that for all practical purposes, it's a reasonable assumption that the governments are primarily interested in what happens in their term, in their present term, and that
Yeah.
they want to get reelected, and these political pressures to get reelected incentivize them to do various kinds of populist expenditures. And the technical or the modeling insight from that is that what the governments care about is how they can generate maximum cash flow to spend. Now, cash flow to spend can come from your tax revenues, or they can come from funding the deficits with debt markets. Okay. Now, this is crucial because this says that if you want to spend more than your current period tax revenues, you have to be able to borrow in the markets. Now,
Yeah.
what's a debt claim? The debt claim that the government borrows is going to then become payable by the next government, the government after that, the government after that, and so on. So, through that concatenation of calculations, essentially issuing market finance, such as a debt claim, is basically monetizing the entire stream of future tax collections that other governments are going to collect. Because the
Yeah.
capital markets are not just lending to you against the taxes that you are collecting in your term, but these are longer term contracts, or they might get rolled over. Some of it gets pushed over to the next government. So that's the insight, which is so the first insight is that the governments are interested in spending as much as they can. Therefore, they want
Mhm.
to tap the bond markets. But the bond market is basically a claim against the stream of tax collections in future. So now,
Yeah.
therefore, the government in its policy choices, the way it works well is that they say, oh, I shouldn't really, even though I'm myopic, I don't have to just focus on taxes in my current period. You can tax the hell out of the corporate sector. But then the bond market says, oh, they're going to have very little investment in this economy. There's no cash
Mhm.
flows coming in future. So what's the debt capacity of this economy? It's not very great. I'm not going to lend much to this economy. So even though the government is myopic, because the debt investors are actually doing the calculations of what cash flows are there in future to repay us. The government says maybe it doesn't make sense for me to tax the hell out of the current investment engine. Let them invest. Let the future governments collect taxes from this investment engine. As long as bond markets are willing to lend to me against that, this is not such a bad thing because I don't have to finance everything through taxes. I can do my deficit financing by meeting that financing through bond issuances. Now, where it doesn't work very well is when the government starts losing credibility about the debt financing, which is that it's not clear whether the future governments have the incentives to repay the debts or not. Because if the market believes that there's not much of a commitment to repay this debt,
Yeah.
then they say, okay, there's nothing in the future tax flows. All that matters is what you're collecting right now. Now, what
So how
happens
does
is,
the
yeah.
sorry to interrupt. So how does the bond market assess credibility? And I'm thinking any default in do they remember it? I'm thinking I don't Argentina or I don't know much about this, something like that. So any past default, does the
So governments are typically shut out, I would say, for a short period of time. I would say it could be anything from 6 months to 18 months, maybe at most 2 years. There's debt workouts, then there's some renegotiations, either from your multilateral agencies that give you the aid, your bond market. Sometimes there are legal cases, etc. But what you find is that the idea that somehow you're going to get shut out from bond markets forever, and therefore
Hmm.
you'll keep repaying the bond markets regardless of other incentives, doesn't hold up in data. Just think about how many times Argentina has defaulted over the last century. Now, of course, that's possible only if it was in the bond market again and again after some workouts of its debt. Um,
Yeah,
but but I think that's an interesting example, the Argentinian one, because it says that unless you fix the growth path of the economy and make it credible
hmm,
that the debt is going to be repaid by future governments, all governments, the moment you get access to the debt markets again, they keep doing the same thing, which is we're going to spend as
yeah,
much as we can to the hilt, keep increasing the debt burden, and at some point a shock is going to come and hit you. Now, so
hmm,
the question is, when does this debt access become a double-edged sword, which is when does it not
yeah,
play out in the good way that I was explaining earlier, which is that the government's in the good way, the government says, no, no, let me invest in future because I can anyway
hmm,
borrow against that in the bond market. Now, when your
yeah,
commitment is not high, when the bond market say, listen, what's the chance that these future governments will pay me? It's very easy for them to default and walk away from this debt. Then the governments need to build credibility that it's
hmm,
not easy to default on the government bonds.
hmm,
Now, there are many mechanisms for this, but one mechanism that we explore is that you basically entangle your financial sector and its transactions with your bonds. So,
yeah,
you have your banks and the large insurance companies or pension funds buy the debt of the government. So that's a form of financial repression. You can have taxation in favor of government bonds related to other kinds of fixed income instruments or investments that's channeling savings of the economy into the government bonds. You
hmm,
can help create a repo market, which basically means that a lot of interbank borrowing will start happening in your economy that's collateralized by the government bonds. Now,
hmm,
some of this is financial repression, some is economic repression, some is actually making your financial sector sophisticated. But in
hmm,
our sort of very extreme view, perhaps, but not completely unrealistic view, all of these are mechanisms to give confidence to the markets that
hmm,
it's going to be costly to default on this bond market because it's
hmm.
entangled with my banks, it's entangled with my insurance companies and pension funds. The repo markets will collapse if I default on this debt. So now you start building confidence in investors' mind that no, these bonds are going to be repaid because they are such a big part of financial system. How can the
Yeah.
government walk away from this debt without triggering a full-blown crisis on itself? But
But
now
it
to do
sounds,
this, just
yeah,
one last point. But now to do
yeah,
this, either you have to repress the financial sector, in which case you
hmm,
are cutting off private investment, or you have to make tax advantages the treasuries, which is again effectively making private investments less attractive. So now you start getting the downside where, because you want to keep your debt tap going, you actually
mm,
constrain investments and repress the financial sector and savings to all get channeled into the bond market. And now
mm,
what we show is that you can get growth traps, which is that the reason why
yeah,
governments are then not able to pursue high growth strategies is because their focus is just on keeping the debt tap going. And the way they
mm,
keep the debt tap going is to say, no, I'm going to actually incentivize more and more savings of my economy to go into the domestic bond market. Then it becomes very hard for me to default. And then the
mm.
foreign investors say, oh, it's okay to keep giving debt to this government because they are not going to default on this debt. But the economy now gets trapped into a low investment, low growth path as a result of this.
But if the memory of the debt providers is short-lived, whether it is confidence or lack of confidence, then the optimization problem for the government of a developing country is to basically borrow as much as they can, right?
Exactly. Yeah. But the whole idea is that how much you can borrow is a function of your policies.
Yeah.
So that's the key technical insight, which is that your
Mm,
debt capacity is not a given. Sometimes you can expand your debt capacity by pursuing growth because you are expanding the pie of future cash flows. But
yeah.
in a developing economy that doesn't have a well-established financial system, there may not be much credibility to repay the debt, as we were discussing in the case of Argentina. In this
Yeah.
case, sometimes it may be profitable for the government to actually develop the domestic financial system, or channelize more of the savings of the economy into the debt markets, and that's the way you actually boost your debt capacity. Now, of course, the two have very
Yeah.
different implications for the growth path of the
Yeah.
economy.
Yes, if I understand this correctly, Viral, so there appears to be some sort of old development for a country. You saving country, the lengthening of the government's effective horizon can incentivize it to tax less, resulting in a with higher steady state household consumption than if it could not borrow abroad. So that one is sort of the state or the of current development. One appears to be sort of the saving rate of the country.
Exactly.
And so it is truly an optimization problem, isn't it, for for the government too. So as you say, you might get trapped in some sort of a growth trap in some less developed countries. That is issue.
Yeah, that's exactly right. So what happens is so it's very interesting in a lot of emerging markets. If you talk to macroeconomists there, they are always thinking about the savings rate, the domestic savings rate of the economy. Now, actually, there is not a lot of international macro research which puts the savings rate of an economy at like the center of the development question. There is some, and we cite that in the paper, but that's not like the working paradigm. And actually, our paper and our model offers a very nice way of rationalizing why emerging market macroeconomists and central bankers are paying so much attention to the domestic savings rate. And the idea
Hmm.
is the same. Basically, if the domestic savings rate is high, then most of what you borrow is against the future stream of the capital that the economy is going to be allocating, because the economy is not consuming a lot in the current period. It's actually
Yeah.
leaving a lot behind through savings rate, high savings
So
rate.
it's sort of de-risked borrowing in some ways,
Exactly,
right?
exactly. It's sort of saying that the economy is leaving a lot of capital investments through the savings, and that those capital investments are going to generate future cash flows, and now it's going to be able to borrow against that. But in an economy in which the savings rate is not very high, most of it is spent into current consumption, there's not much
Yeah.
cash flow that is left behind.
Hmm.
And so now what happens is the current governments try to increase savings, but they are not
Yeah.
interested in savings now going into investments. They want to
Hmm.
channel them into the domestic financial sector and the bonds because they want
I
to
see.
increase the credibility to investors that it's not easy to walk away from repaying
Hmm.
these bond markets. And so
Right.
so when
So
savings
that
rate
is.
Yeah.
Yeah.
So you get financial repression in an economy when the savings rate of the economy is low because the
Yeah.
government wants to steer more of the savings into domestic bonds. And this is a
Mm,
way of building credibility with external investors that you won't
mm.
just walk away from the debt at the first opportunity.
Yeah, it's a bit like, in private equity or hedge funds, when you look at investments purely from financial perspective, I should say private equity or venture capitals, suppose I look at a transaction purely from a financial perspective, I get an answer. But if I look real investment perspective, I get a different answer, right? So something analogous is going on here, right? From a government perspective in a country.
Yeah, absolutely. So what it says is that when a country is in a growth trap, you could have this beautiful situation from the government borrowing side, which is that they're
Mm,
continuously able to borrow, roll over their debts, etc., etc. But the governments are just using the debt that they can get on populist expenditures.
yeah.
Their high levels of borrowing are crowding out private sector investments. The economy can't grow, and yet the debt markets are willing to keep funding the government deficits. So,
Mm,
so on the it looks like macroeconomic calm on the deficit financing side, but it's actually a gradual erosion of the growth capacity of the economy. In fact, we show that it can become a growth trap. You may never be able to come out of this unless there's some exogenous shock that causes you to default, and then you have to restart your economy at that point again.
say here very clearly, in a country that saves little, the government may engage in repressive tax policies, as you were talking about, to channel domestic savings into government bonds. So that's sort of also crowding out private investments in some.
Absolutely. So in our model, and I believe also in data, like financial repression and crowding out of private investments are usually just mirror images of each other.
Mm,
And so financial repression, even though that's the more popular term, is a form of economic repression because you're effectively
right.
crowding out private sector investments when you do that. And that's precisely how
And
the growth trap materializes. The reason why growth trap
yeah.
materializes is that you engage in financial repression to keep the bond market going, but
Mm,
this actually creates an economic repression in terms of low growth. Jill, can I
mm.
just take your phone?
Yeah, yeah, absolutely.
Hello?
Hi, this is Baral, right?
Sorry, it was my son's
Oh,
tennis.
so no worries, no worries.
Yeah.
So, so I'm just thinking, well, that is this a problem we can predict? Because there are a lot of parameters here, right? So, savings rate, current debt capacity, going, what is the proportion of private and public debt, also domestic and international debt. There are a lot of parameters here. So can we predict the probability that a country is going to get in a growth trap, looking at all that data?
Yeah, that's a very I would say very exciting question in some ways because what the model sort of shows is that the standard practice is to do debt sustainability analysis.
Mm,
But I think you asked an interesting question, which is maybe we should not be asking the question just about the debt sustainability of a country, but whether a country is likely to be in a growth trap, even if its debt is sustainable or not. And what our model says, and I think therefore I'm glad you picked up on that point, is that what our model says is that the key parameter is the savings rate of the economy.
mm,
Like
mm,
what proportion of the wealth is the each generation in the economy saving back into investments in the economy. If this savings rate is high, our model, of course, is not calibrated quantitatively to do such an empirical exercise, but that would be the spirit of an empirical exercise, which is that even when debt is sustainable, there'll be information in the savings rate of an economy, whether it's likely to be on a growth enhancing path or whether it's likely to
Yeah.
be in a growth trap.
So how does wealth disparity? I know that this is not in your model, but how does wealth disparity play into it? And I'm thinking about India. Has 200 billionaires. Is creating apparently a millionaire every 30 minutes, whereas 800 million people making less than $7 a day. So this is the most grotesque form of wealth disparity humanity has ever faced, I would argue. So how does that play into this growth trap prediction?
So I've been actually I've been trying to get data from India on savings rates, which is actually divided across the distribution of wealth.
Yeah.
And surprisingly, actually, the data are not easily available. So you see this constant refrain, as I was saying, from the macroeconomists that they are not happy that the savings rate in the economy actually has been declining over a period of time. What happens is that, of course, there are times when foreign capital is more abundant. So right now, we have a little bit of a Goldilocks situation in the sense that China is doing so poorly that
Yeah.
one, there is a mechanical rotation because of correction of its equity market weights in various indices, and that's spilling over to India. But there's also a long-term shift of investments that is taking place, looking for other larger markets, both on real investments as well as financial investments. So what happens is for a while, even if your savings rate is declining, if just by happenstance you end up in an
Mm.
environment where there's more ebullient foreign capital flows, then
Mm.
you get buffered for a while. So, but the
Mm.
real question occurs is when the foreign capital is not as easy to come by. Now it's looking for credibility that debts will be repaid. And now your
Yeah.
low savings rate becomes actually problematic. Now, what I've been
Mm.
wanting to know is it so because on the face of it, everyone says that because there's so much wealth creation at the top, money is going a lot into housing markets,
Yeah.
into luxury housing markets in particular. It's going into stock markets and some
Infrastructure.
other kinds of speculative
Yeah.
assets as well, and so on. Now, it could be that the government is actually pursuing relatively low tax strategies at the present moment, which, if you
Mm.
take our model seriously, would actually say that this is good actually for creation of capital, creation of growth, etc., etc. But of course, what they would have to watch out for is that if anyway most of the tax base is actually where the savings of the economy are high, then
Yeah.
presumably you could end up with a situation where there's not much money that's going into your bond markets. And then you would have to ask the question, okay, and as I said, right now, people would say, what are you talking about? There's no problem at
Mhm.
all funding our debt markets. But that's because foreign money is right now relatively abundantly available to chase us. But suppose there was a global market correction, an unexpected election outcome in India or somewhere else, VIX rises, there's a financial sector concern. In all of those scenarios, the foreign money will be held tight, and that is
Mm.
when it will actually matter whether there's enough savings of the economy that are naturally going into capital and bond markets or not. And otherwise, there could be an issue over here. The second thing I would point on the
Yeah.
distribution of wealth, which is outside of our model, in two ways. One, which is that we only have a homolithic household sector in the model. As we discussed, we also don't vary the myopia and the populism parameter of the model of the government in the model. But of course, in principle, both could be varying. And so it could be that when you have a more uneven distribution of wealth and you get an external shock, you are
Mm.
more likely to see actually repressive financial policies because the government has to embark on highly populist measures when growth slows down.
Mm.
So it could
Yeah,
be
so the
that in a
yeah.
more general model, the distribution of wealth is actually in itself a source of fragility on the bond market. Why?
Mm.
Because if wealth distribution is uneven, the demand for populism will rise when growth weakens. But now this
Yeah.
endogenously will actually make that the government will follow repressive policies rather than growth
Mm.
enhancing policies because all that they are interested in is how do I borrow more in the market right now. So
Yeah, so in engineering terms, it makes a country more brittle
yeah,
or more
exactly,
risky.
exactly. Yeah.
But on the same lines, so I look at India now. My dad was a professor of engineering in the southern state of Kerala. He can have his pension nowadays. Um, as elections are going on in the country, uh, the seats uh, that is in 6 states. Look at capital flows. Those 6 states are basically getting flows. That is also a sign of sort of brittleness, right, for the economy. It is a wealth distribution problem, but in this case, macro wealth distribution problem.
Yeah. No, I think in some ways I would say India has always had this, and we are sort of gradually getting over it to some extent.
Mm.
If you think about 50 years back, Maharashtra was, like a big driver of growth, but now many other states have also started competing, I would say, and maybe even overtaken it in some sense in future and potential of the state. The good thing going for India is that unlike some other regions, India is actually a fiscal union. We have a federal government, we have a federal cooperative structure between the central government and the states. So I would say, you have to work on the fundamental development of your weaker states in the early stages of their growth. This requires transfers from the better doing states
Yeah.
through the fiscal authority. It requires investments in infrastructure, health, education, investments, which could, sort of catapult more private investment into the state and so on. The flip side is that, of course, for all this to work, it better be that your federal cooperative structure between the center and the states is actually working well. The states are not
Mm.
feeling rebellious because of a disproportionate collection of taxes and cesses, which primarily go to the central government. If more and more of the welfare delivery, which historically used to be done by the state, gets done by the center, that could also
Yeah.
create some tension in this cooperative structure. So, to me, I think uh, the issues about internal transfers are a little bit less of a concern to me from one state
Okay.
to the other because we have a fiscal
Yeah.
union precisely to achieve that. Maybe it's even an advantage, I would say, to help
Mm.
the growth of the states which are lagging behind in their growth or not up to their potential. I think the real concern to me is what's the right balance in
Yeah.
what the center does and what is delegated to the level of the states. Is the politics of the country divisive or is it keeping the structure united, both in a financial sense as well as on softer non financial dimensions? To me, those
Mm.
might be more crucial issues
Yeah.
of brittleness or fragility than these internal transfers across states through the fiscal.
Okay. Okay. Yeah, so Raghu was on the Farid's interview recently, and I haven't really thought about this. So I want to get your perspective on it. So he was arguing that, yeah, 6% growth is great. Then to get out to a developed state, you need a lot more than that. And so, you can look at South Korea, you can look at other countries who have gone through these phases. So India is getting, he said, big population dividend right now. There are a lot of young people. We should be seeing, we meaning India, should be seeing lot more growth than 6%, right? I mean, for it to sort of get out of the trap that it's in.
Mhm. Yeah, no, I think that is in some sense the multi-billion dollar question, I think, on the table. And I think to me, there is investments that have picked up. There's a lot of public capex. I think private capital expenditures also seem to be showing, I would say, in the last 12 to 18 months, I would say now stable signs of recovery. To me, in the end, it's that the job market sort of gives it away in a way, like I
Mm,
think you've got to be able to create jobs in a country, as you said, where the population dividend is so high. And as I was mentioning earlier, even if the growth right now is of actually robust nature, but if it is not creating the level of jobs that your country requires, as I was
yeah.
explaining earlier, my concern is that come a growth shock, this will lead to terribly populist policies because you've just
Mm,
not created enough economic livelihood in the distribution
right.
of the wealth in the economy. So I think in one way or the other, I feel that, of course, there's a reason why everyone focuses on the GDP growth numbers, because if we had to pick one metric, that is the most interesting one. But once you
Mm,
start thinking about the longevity of their growth, the fragility of their growth or brittleness, as the term you used, what kind of shocks might it be vulnerable to, etc. I think once you go into that, then I think the headline GDP number is not enough. Then I think
mm,
distribution has to come into play. You have to look at employment as a sufficient indicator. And to just give you an example, why is the Federal Reserve's mandate in the United States focused not just on
mm,
price stability, but it's also on employment? Because it says, listen, both growth and stability are important. The same way Monetary Policy Commission in India, its MPC is focused on inflation, but while paying attention to growth. So there's a very built-in inherent recognition, I think, in these policy mandates, in the macro discussions, in the financial economics discussions, that basically growth and its stability or growth and its fragility are both important to focus on. And so that's my main word of caution to the
mm,
over reliance on a single GDP growth number, because believe me, in the short run, you can even manufacture high growth.
mm,
you know
yeah.
you could have a bumper exports here, and suddenly your growth will look very high, but that growth is very dependent on the growth of the rest of the world. So to know whether your growth is stable, does it have the longevity, or is it brittle, what sort of brittleness and fragility risks it's exposed to, you have to look at a few more metrics. And I would say at a minimum, the job creation rate keeping pace with your population growth rate, and similarly, what's the wealth distribution in the economy. I think these are pretty reasonable indicators of whether the growth is even, it's balanced,
Yeah.
it's well spread. And just a last point on this, which is, you can keep creating wealth at the top, but how much can they consume? At some point, they can't keep consuming at 8 or 10% growth rate forever. So at some point, for your consumption engine to be robust, it has to be that the consumption is robust at different points of the wealth distribution. But now, if your
Mm,
wealth is getting created more and more at the top, at some point, your fast moving consumer goods companies are going to say, listen, we are not able to sell at the last mile. So, why is it? I find it quite a revealing statistic in India that at a time when the stock market is booming, at a time when the luxury housing market is booming, at a time when the overall growth rate of the economy is booming, FMCG revenues and sales number look among the weakest in the economy. And
yeah.
the only way to make sense of that is that actually the job creation is not even across the wealth distribution.
Yeah. On the consumption side, I have to say, if you throw wedding parties that cost 100 million, that should have some economic,
Yeah,
um,
absolutely.
but
Hmm.
not many people can do
Yeah.
it.
But I would say I think it's really a question of magnitude, which is that uh, that's a small part of the economy. In a particular set of weeks, it becomes a very big part of the economy, but that's not enough to actually sustain livelihoods all during the year. So
I understand. Yeah. So I want to go into a few more of your papers. One of them common ownership and incentives to decarbonize and innovate. So you say here, we study a model of carbon emissions and green innovation, which features both an environmental externality in the form of damages due to the stock of carbon and technological externality in green innovation. When two Pigovian instruments, carbon taxes and green innovation subsidies, are available, the social optimum can be efficiently decentralized without binding commitments by. On this also very, very interesting, little bit counterintuitive again. And so arguing here is that when you have large firms, you need a lot of subsidies. We move toward an optimum green innovation posture. Is that the way to think about it?
Yeah, I think the original insight goes back to work of Daron Acemoglu, Philip Egyon, and co-authors who basically explained that climate change is a problem of reducing emissions, but it should not be seen just as a problem of reducing fossil fuel consumption. That to simultaneously maintain the output of the economy, there has to be a technological transformation to alternatives to high emission intensity forms of production of energy. And so you have to achieve this technological green transformation, be it, how to store the energy better, how to generate it better, how to reduce the risk of intermittency of this generation of renewable powers, and so on. And so the idea there, therefore, is that you can impose carbon taxes, and that's a good way of reducing like the wrong type of emissions. But you
Mm,
also want to incentivize this technological transformation to change the factors of production from high emission to low emission intensive production factors. Now, the key insight that also Asimoglu, Egyon, and co-authors had is that innovation generally, especially of this technological innovation type, is found to have substantial externalities. So if I innovate and design a green patent, over time the stock of this innovation has a huge beneficial factor, not just on my productivity, but also on actually productivity of everyone else. So suppose tomorrow someone makes a breakthrough and comes up with a better way to store renewable energy. This is going to have a huge amplifier on greenness of everyone else in the economy, because now we
mm,
can produce renewable power when we can and store it and move it across states of nature over time and so on. So the idea, therefore, is that you will need two instruments to actually do it in the right way. You have to disincentivize brown emissions, but simultaneously you have to actually create an incentive so that people are making the right kinds of technological innovations, R&D, technological transformations, etc. And then where we come in is the situation we analyze is to say, listen, this world in which you have two externalities, one is an emission externality, one is an innovation externality. And okay, I have two tools, then I can tax carbon and then I can give a subsidy for green innovation. That, this is like a kind of like a utopian world in a way. Like governments usually don't have the
yeah.
ability to actually design policies so flexibly that you can charge Pigouvian taxation or give a Pigouvian subsidy wherever it makes
Mm,
perfect sense. So we take the example of Europe, where there's a lot of carbon tax, but there isn't an
yeah.
innovation subsidy. And then we take the example of US, where there's actually innovation subsidies for green technology in the Inflation Reduction Act, but there isn't much of a carbon tax yet, even though there are some
Yeah.
drilling restrictions here and there. And then we analyze what will be the nature of the transition from brown to green in this two kinds of economies. And then what role now can large firms play, or
Mm,
what role can large investors such as BlackRock or Vanguard, who actually own huge quantities of firms, or a large private
mm,
equity firm like Apollo, which actually owns
yeah.
several portfolio companies. what role can they play? And what we explain and give, I think that's sort of our main insight, is that these large firms or large investors, or what are sometimes called as common investors, because they are invested in a pool of companies, that they can actually see that if we get our companies to innovate,
Mm,
others will innovate as well, and then we are all better off. Why?
mm.
Because if we are innovating and producing with green, we'll have to pay lower carbon taxes in future.
The
So,
future, yeah.
so
So it's sort of a discount problem in the sense that if common investors are looking forward sufficiently forward, they will discount the future optimally. Is that the way to think about it?
Um, yeah, I would say, means of course everything in some ways can be converted into a discount rate, but perhaps the simplest way of thinking about it is that if I'm a small company or an atomistic individual, I don't believe that my action changes the macroeconomic state of the world. But if
Yeah,
you're a large enough company, if you
yeah.
can be 50% of the green innovation of the economy,
You can make a difference. You can
you
make a huge
believe that
difference.
if I do this, so will others, and therefore we'll all reduce our carbon tax bill. Now, the beauty of it
Correct.
is that it's true that everyone else who's free riding will benefit even more than I did. But I don't care.
Yeah.
As long as I'm reducing my carbon tax bill in future, it's efficient for me to actually make the investments and over-invest in some sense relative to what I think is my private gain, because this way we are all better off. But all that matters to me is that I am better. So the nice thing
Right, right.
about the logic is that it's not that Larry Fink of BlackRock is pursuing green innovation or net zero alliance formations for the companies that BlackRock has a large presence in out of the goodness of his heart, or
Yeah,
out of some kind of preference for climate change. It just says no, carbon taxes are coming. We want to
yeah,
reduce the carbon tax of our companies. How do we do that? We have to become green. If we
yeah,
become more green faster, so will others, and then the innovation will get huge externalities,
yeah,
and then we are all better off in reducing our carbon tax bill.
yeah. I like that.
So
Yeah.
they
So,
are entirely
yeah,
profit maximizing, but they are not atomistic. They actually
yes.
internalize that, but through their actions, they're changing the macroeconomic state of the world. And by changing that, I'm reducing my own carbon tax bill in the process.
Yeah. Or expected future carbon taxes. I think
Exactly.
the one question would be, suppose there is a huge technology change, like, we get fusion or something like that, that makes the environmental issue completely go away tomorrow. Uh, and then, all the things that they have done in anticipation of the status quo would be of negative NPV for
Yeah,
their
yeah. So in
shareholders,
a
right?
way,
Yeah.
businesses are always factoring in these sorts of risks when they make innovation decisions. I fully agree that, what's the shelf life of an innovation? What's the risk of, this remaining a concern or not? What's the likely uncertainty of policy? They will be factoring in all of these risks when they make their calculations. We don't have a model which has a ton of these uncertainties. In fact, it's actually mostly a deterministic model. The
Yeah.
issue that we analyze is more of commitment, which is that does the government have enough flexibility to actually tax the way it wants or subsidize the way it wants? And if not, can some firms, by acting as Stackelberg leaders, to use the
Hmm.
sort of strategic game theoretic language, can some
Yeah.
firms act as Stackelberg leaders, push the economy onto a green path? And
Hmm.
actually, now it's no longer important for the government to actually have too high a carbon tax,
Hmm.
because actually the firms are doing the work for the government in a way. Yeah.
Yeah. Yeah. But, if I were the CEO for, I would want a sort of a portfolio of options. I'm not going to exercise them, but things become a little bit more clear, I'm going to exercise them. Do you see that behavior? Yes.
No, generally most people think investments as a whole, but not just in
Yeah.
R&D, but even basic capital investments, especially if they are irreversible, like either into human capital or, like mining explorations or, setting up huge labs or use huge R&D facilities, etc. These are pretty irreversible investments. So there's always this real
Yeah.
option delay that happens. But that's
Yeah.
exactly where we don't analyze it, but that could be another mechanism through which subsidies could actually play a very big role. And in fact, that is what
Right.
if you talk to practitioners who are sort of focused on climate change developments, they do believe that Inflation Reduction Act of 22 through this whatever 300 to 400 billion dollars of green tax
Mm.
credits has actually created a lot of momentum of green
Mm.
investments, which was
Yeah.
hitherto held back, maybe in part because of the real optionality reason that you mentioned, which is it a good time to actually invest in this technology given all the uncertainties which are out there?
Yeah. So I want to go to another paper. We are running out of time. So contingent credit under stress. You say here over the past 2 decades, banks have increasingly focused on offering contingent credit in the form of credit lines as a primary means of corporate borrowing. We reviewed the existing body of research regarding the rationales for banks' provision of liquidity insurance in the form of credit lines, their significance in managing corporate liquidity, and the reasons and circumstances under which firms opt to utilize them. So I can see it from the firm's perspective. I'm getting an option and I'll pay a little bit for it. So I guess there will be sort of an upfront fee and there'll be some maintenance fee going forward. So I can compute what that option is worth to me. But why would the banks do this?
Um,
Just for the fees?
yeah, so I was going to say there could be two reasons. One is that banks typically are sitting on reserves, which is basically what you get into bank's account when deposits are made. And they are often not earning much interest or a low interest
Mm.
on these reserves, and then they want to make money on it. So the world needs
Yeah.
liquidity. The world needs, so small firms need to manage their working capital risks. Businesses like hedge funds, broker dealers, and others who are constantly in the market for trading, underwriting securities, they get unexpected demands for liquidity. So they want to have a tap that they can always keep accessing for liquidity every now and then. So from the bank standpoint, I would say one, they are in a position to actually provide the liquidity in a credible
Yeah.
manner. One, because they have access to reserves on their balance sheet. They get a lot of inflows of deposits in stress times if there's a flight to quality and banks are healthy. And second, because there's a demand for actually liquidity
Mm.
lines, because a lot of firms need it for working capital reasons or to manage various types of liquidity risks that they have. And even large corporations, which are in equity markets, which are in bond markets, their CFOs and treasury operations, they always have large lines of credit from the big banks because for the state of the world in which the capital markets go for a toss, uncertainty rises a lot, market volatility increases a lot, they still use bank credit lines as a last resort measure
Mm.
for generating liquidity, being able to meet your payroll, being able to meet your investments if you had already planned for them, and so on. So I would say it's basically a mix of demand and supply, like in
Yeah.
any market. But banks have some inherent advantages relative to other financial intermediaries because they are the place where the reserves are kept in the
Mm.
economy.
There's a bit of asymmetric information here, right? As of probably no more than the bank. I'm just speculating here. And so I would imagine the prices that the bank is charging, upfront fee and maintenance fee, I guess take into account this asymmetric information between the bank and the firm.
Yeah, so I would say on average, they definitely do this. So you can see that for riskier borrowers, even the upfront fees are actually higher, not just the drawdown fees, but even the upfront fees to get these facilities are higher. In fact, beyond a certain credit rating and beyond below a certain size, it may be even hard actually to get liquidity insurance in the first place, because we know from one micro 101 that basically the moral hazard and adverse selection consequences of giving insurance are very high
Yeah.
for these types of borrowers. So the market even breaks down in certain regions. Now, to
Mm.
prevent that breakdown, of course, banks create mechanisms. They sometimes will make a loan only against collateral. They will agree to making a loan only if there are tight covenants attached. Even
Mm.
on top of these covenants, they always reserve a clause called as material adverse change clause, or MAC, as per which they
Yeah.
could deny a credit line at the point of it being drawn by saying, no, you did something to actually change your material credit quality and then draw down on our
Mm.
credit line. So, of course, banks
Mm.
have some defensive mechanisms. Yet, I think the question you asked is super important, which is a lot of credit lines are seen, as I was explaining, drawn in a correlated manner when there is market-wide stress. Because now
Mm.
even large firms start drawing down, not just large real sector firms, but also large
Yeah.
non-bank financial companies start drawing down on banks at that point of time.
Mm.
Now, once a line is drawn down, of course, the bank has to manage the credit risk of that loan. They have to set aside
Mm.
capital for that. So, precisely in the bad state of the world, banks actually
Mm.
get correlated drawdowns. Now, while it's true that they
Yeah.
may be the natural providers of liquidity in that state of the world, ideally they should still be pricing this risk. Now, what we are
Yeah.
trying to understand in our research is, are they doing this? Because these are also market-wide stresses, are also the states of the world in which
Mm.
central banks have started being more generous in giving lender of last resort liquidity to banks. Banks which are
Mm.
under stress are now more often bailed out than let go and be made to face consequences of that.
Mm.
Similarly, non-bank financial companies, if they draw down, maybe banks think if the non-bank is going to be in trouble, once again they will be supported because they might be systemically important, etc. So it's
Yeah.
possible that while the private mechanisms left to their own devices would actually price the risk of providing insurance and the moral hazard and adverse selection consequences of it, if there are public backstops, then the
Yeah.
states of the world in which public backstops are going to become available may stop
Yeah.
getting priced in these credit lines as a result. And then you could get an excess of systemic risk being undertaken
Yeah.
in the economy because banks are underwriting it. And the calculation is that, oh, we don't have to charge too much for it because someone's going to come and bail us out. Someone's going to come and give us lender of last resort at that
The
point of time.
taxpayers. Yeah. The
Exactly.
taxpayers will bail them
Exactly.
out.
Exactly.
And so, from a regulatory perspective, suppose I were a bank and offer a credit line without any assets supporting it. I mean, is that possible?
Yeah, it's possible. Like many small businesses actually in services sector, they don't have too much collateral to offer. But I would say their cash flow information, whatever records the bank has through the trail of the transactions they are doing, banks will have access to what kind of cash flow in and outflows are happening in the checking account. So banks
Yeah.
can use information as a collateral to optimally design the credit line contract for them. In fact, small
Yeah.
businesses typically use bank credit lines for working capital needs. They are
Yeah.
typically drawing down 45 to 50% of their credit line every quarter, but then repaying back, repaying back, repaying back. So clearly, banks
Yeah.
must
Yeah.
be designing the maturity of the contract, the interest rate that has to be paid for all of this to
Yeah.
work well most of the times. But as I said, when there are correlated drawdowns, then of course it becomes a problem for the bank, and then they might increase the cost of new credit lines at that point of time. And what a body of
Yeah.
research now shows is that when large correlated drawdowns happen in times of market wide stress, who is
Yeah.
dependent on new credit lines all the time? It's small businesses. So they are
Yeah.
the ones who bear the brunt of banks
Right.
selling cheap credit lines to large firms and non-banks
Mm.
because they think
Yeah.
someone's going to bail me out. But then
Right.
if the bailout is a bit slow or it takes 3 to 6 months for it to then trickle down to the small businesses are the ones who experience the credit crunch at that point of time.
Yeah. The big guys always win. So I want to finish up with one. So, do firms mitigate climate impact on employment? I found this very interesting, Viral. So, evidence from US heat shocks. You say here, how do firms mitigate the impact of rising temperatures on employment? Using establishment level data, we show that firms operating in multiple counties in the US respond to heat shocks by reducing employment in the affected locations and increasing it in unaffected locations, whereas single location firms simply downsize. Yeah, I never thought about this. So this is actually happening. Firms are doing this, that they pull out from areas they believe has some sort of environmental issue, heat shock being one of them, and they increase employment elsewhere. And I remember reading through this paper, I remember you saying it's not really transferring employees from X to Y. It's really you just lay off people in X and they hire more people in Y, right? That's what you're finding.
Yeah, exactly. So I think it's a little bit of, I would call it like, maybe it's like risk management or hazard management or operational engineering, whatever you want to call it. But the simple idea is that, let's say, suppose you have like two or three mine locations and you never use these mines to their full capacity. Then you can choose how to optimize your capacity utilization in different parts of the locations that you have. And then suppose you realize that one area is either getting very hot or there's a lot more hazards there, then you have two ways to go. Either you could so let's say you can improve the conditions that you have for your workers to not get hurt. It could be a warehouse, in which case you would have to really improve the air conditioning standards that you have. Or you say, listen, it might be better to recognize that this is a chronically impacted area. When the shock
Yeah.
occurs, sometimes it's even very acute. And rather than investing in extra air conditioning, rather than paying higher insurance premia for insuring my employees in this state, maybe over time I should actually move my capacity to another warehouse, and then I can sell off this warehouse at some point of time in due course. So basically, we think that through this kind of operational engineering, now, of course, you might say, are the firms really doing this? And which is what we are trying to demonstrate, that yes, indeed, they seem to be
Yeah.
doing this. And it's not surprising. Firms do this all the time for tax reasons. They're all the time trying to say, no, let's move to this state or this country because actually, the taxes are lower over there. Sometimes they may do it only through where they are recognizing the profits rather than physically moving out there. Here it's true operational engineering because you're actually increasing jobs in less exposed locations relative to where there are more exposed locations.
Yeah, so
I,
but
I,
but you didn't find any population differences, right, between those places. So in essence, you lose your job if you are sort of affected area. So what you see is in these counties where there is a heat shock or whatever environmental issue that we are dealing with, you have higher unemployment, right? That is what we are seeing, isn't it?
Yeah, exactly. And I think one reason why actually the what you are finding increasingly that people are not migrating as much as
Yeah.
they historically used to. They are more locked down at their homes, especially in a high interest rate environment, because you might have locked in a low interest rate mortgage in the past. That's one reason. Second reason is that uh, of course, if you are with a large company, as I was explaining, they might even benefit actually in the short run in the region because small businesses, small companies are the ones who don't have multi locations to actually do this optimization. So they are far
Yeah.
more impacted actually by the immediate costs that you have to incur if this physical hazards that a location is exposed to or a county is exposed to become high. So they might even, large companies may even see actually a little bit of movement of jobs towards them, even within the affected counties. So overall, there is an
Because they
impact.
can reduce salary. What's the incentive there? Because the large companies could potentially hire at a more
Yeah,
favorable
basically,
contract?
yeah, it would be
Yeah,
cheaper. It would cheaper because a lot
yeah,
of people are leaving small companies at that time. So then you have to balance, the attractiveness of going to a less exposed location with the fact that labor is actually cheaper in the location that you are in,
mm,
because when you are affected, actually small outfits lose their labor to the larger outfits. So it has some consequences for internal distribution of jobs and activity within a county between small and large firms, but then it has some spatial implications of for how economic activity will actually get reallocated from less exposed to the more exposed region. Now, depending on how you see it, you can see the research as either showing the bright side or the dark side of mitigation, which is the bright
yeah,
side of mitigation is that the multi-establishment large firms are like hazard insulators or heat insulators of the economy. The dark side is that small businesses, financially constrained businesses, single unit locations, they can't have this optimization. So they are the ones who are bearing the brunt in some sense of
yeah,
the climate change in this sense of the word. Yeah.
right. Excellent, Rahul. Yeah, thanks so much for spending time with me.
No, thank you so much, Jill, for having me over. Yeah, thank you.
Thank you.
Okay, very good. Yeah, thanks a lot.